Right. Okay, so let's get started. Hi, everyone. My name's Caroline Wilkinson. I'm a strategic client lead within Empower Business Solutions, and I'll be your host this afternoon. Um, we're really pleased that so many of you could join us for our December update. There's always so much to cover in the world of energy and energy insights, so thank you all. Since our last update, there's been a lot of energy related activity, to say the least. And I just want to run through a couple of call outs before we begin with our speakers today. So, the CBI conference last Monday, the cost of energy for businesses was highlighted as one of the biggest barriers to UK growth and competitiveness. We've also got the much anticipated autumn budget that followed 2 days later. It didn't necessarily deliver the level of immediate support for businesses that we were hoping to see. However, we do know around 7,000 of the UK's most energy intensive businesses are due to receive some help from the British Industrial Competitiveness Scheme when it launches in 2027. The consultation to determine eligibility criteria closes for this in January. On the back of this, we know that there'll be many high energy users who won't qualify for that support. So to cover off some of this insight, we've got Stephen Evans, who'll be joining us today, and we'll go into more detail on how much costs are expected to rise by over the next 5 years, followed by Ben Whitelam, who will talk more on what businesses have told us they would ideally like in his presentation shortly. We are going to cover quite a lot in the next hour, but if you do want to recap on any of the information shared today, you will receive a video recording of the webinar afterwards. So if we look at our agenda today, so firstly, we'll be focusing on 4 key topics, starting off with Emma Trevor, who will cover the key drivers underpinning wholesale prices today, and we'll be highlighting what you need to watch out for in the months ahead. We'll then be unpacking non-commodity costs, so Stephen Evans will explain why and how significant increases in the electricity network, system and policy costs are set to impact your business. Followed on by Ben Whitelam, who will be discussing business reaction to Clean Power 2030 and what companies are asking for, what support companies are asking for. And then finally, last but not least, we've got Matt Cullen, who will provide an update on proposed reforms to the retail energy market and how these may support future cost reductions. So just to call out before we begin and hand over to the presenters, if you do have any questions during the webinar, please type them into the questions option that you'll see on your screen. We are aiming to have a Q&A session at the end of the presentation, so we'll hopefully answer some of those then. But apologies in advance if we don't get to answer them all in time. Please be assured we'll follow up by email afterwards. So without further ado, I will hand over to Emma Trevor, who is a client portfolio manager on our award-winning optimization desk. Emma?
Fab, thanks, Caroline. Hi, everyone. Lovely to have you all here for this webinar today. Before we get started and I introduce myself, we do just have a poll to get us started for today. So hopefully that's popped up on your screen and you will have to submit your vote for it to disappear. So if everyone could submit that answer, that would be appreciated. So we've got, what do you perceive could be the biggest driver of UK energy prices this winter? So is that lower than expected temperatures, below seasonal normal wind generation, interruption to LNG supplies, or finally geopolitical tensions unsettling energy markets? So I'll give everyone a couple of seconds just to submit their answers to that poll. I can see those responses coming in now. So unsurprisingly, potentially, we've got about 65% distance saying that geopolitical tensions unsettling energy markets is going to be the biggest driver of prices this winter, followed by 17% in second place being lower than expected temperatures. So quite solidly in favour of geopolitical tensions being one of the major drivers of energy prices this winter. So let's see what the insight is that we have across the desk. So just before I get started, in terms of our sort of winter outlook, an introduction to myself. So my name is Trevor, as Caroline introduced me. I'm a client portfolio manager for Empower Business Solutions. And my role is essentially to provide a risk management support service to our commercial customers, help them to develop and also deliver their hedging strategies for their power and gas exposure. So the majority of mine and my team's time is spent facing the markets, looking at key drivers, and having a view in terms of where we think prices are going to go over the next few months and years. So a quick agenda in terms of what I'll cover. I only have sort of about 10 minutes, so it will be sort of a very high level overview. If you're interested in finding out more about anything that I speak about today in terms of our winter outlook, we do have a winter outlook research paper that we published on the desk a couple of months ago. You can access that via the Empower Business Solutions website. There is a request form on there as well. But today I'm going to cover a quick overview of power, focusing on sort of renewable generation, how that impacts prices, what the forecast for that is looking like for the next few months, and also the generation margins that we have this winter. We've then got a touch point on gas, focusing on liquefied natural gas, a quick weather update in terms of the weather forecast for the balance of winter now, so out until the sort of end of March, and then a quick summary in terms of an overview of other drivers to be keeping an eye out, and a summary of sort of the other topics, like I said, that are included in that winter outlook paper that we published as a desk a couple of months ago now. So starting with power, so it's the first key driver of energy prices we're going to talk about today, is renewable generation. So obviously, strong renewable generation can exert downward pressure on prices because it reduces the gas for power generation demand. So in Q2 2025 this year, just to give you an idea of scale, the share of electricity generation in the UK that came from renewable sources reached a record level of 54.5% of all generation. So it gives you a really good idea of the impact that strong renewable generation can have on the overall sort of supply mix of the UK electricity. One key source, obviously, of renewable generation in the UK is wind power. And as we sort of see the build out of renewables in pursuit of Clean Power 2030, more and more renewable power can be generated under the same sort of weather conditions. So this year, as an example, we had two sort of large-scale wind farms come online. So the Murray West, which was an 882 megawatt wind farm, and the NNG wind farm, offshore wind farm of 450 megawatts, both coming online. And as a result of these sort of new renewable generation plants coming online, we've seen an increase in the seasonal normal wind generation of 7%. So obviously the actual output of these generation facilities is dependent on the weather and the wind speeds themselves, but the capacity has sort of increased in line with seasonal normal generation by 7%. Currently, the sort of seasonal forecast for the balance of winter are looking relatively promising, and we are expecting wind generation to outturn in line, if not slightly above seasonal normal, over the next few months, which should help to ease any tightness that we might see in generation margins. So the generation margin forecast for this winter that was published by NESO a couple of months ago was 6.1 gig. And that's the highest that we've seen since 2019. And to put it into a bit of context for you, that 6.1 gig is the equivalent to about 10% of the average peak demand that we see in the UK. So they're expecting that to be adequate and within the reliability standards. So no sort of cause for concern there. For anyone who is perhaps unfamiliar with the electricity margin, it's essentially the safety buffer between how much electricity we can produce and how much is actually consumed. So it's the extra capacity that's available to make sure the lights stay on, essentially, even if we get a sudden demand spike. That generation margin has been attributed to a few different things by NESO. So one being the ongoing growth in renewable generation we've spoken about. Also an increase in terms of the battery storage capacity that we have in the UK. So this August, there was a 300 megawatt project that came online. So we're starting to see an increase in the amount of electricity we can store in batteries. We've also expected a net increase in the amount of gas-fired power generation that we've got, and also there's an additional interconnector that came online this year. So that's the Green Link interconnector that runs between the UK and Ireland, and that positively impacts the generation margin, essentially allowing us to import renewable energy from Ireland during periods of low demand, and also export any surplus energy when we need to. So that strong margin is really important for winter prices. It means the sort of impact of any sort of short-term unexpected supply disruptions can be minimised. We know we've got that extra supply there should it be needed. So in terms of gas, as I said, the main point I'm going to touch on today is liquefied natural gas, or LNG, but there are numerous sort of key fundamentals of gas supply and demand dynamics that impact prices throughout winter, things like EU gas storage and that kind of thing. Like I say, in our winter outlook paper, there's a lot more detail. But in terms of LNG itself, so for those that maybe aren't aware, there are currently plans for the EU to phase out Russian gas supply, and by mid 2027. And also we're going into this winter with lower storage supplies than we went into last winter. So the strong sort of supply of LNG throughout the next few months is going to be key to ensuring stability of supply and also limiting any price volatility. The International Energy Agency has forecast a 50% increase in terms of the amount of LNG that is available on the global market by 2030. And we are starting to see that come to fruition now. So one example is the Plaquemines facility from the US, which came online earlier this year. And for context, the US became the first country ever to export 10 million metric tons of LNG in October. So that was a record, very closely followed by another record month in November of 10.9 million metric tons. So the US really starting to ramp up their production now and exporting more and more LNG in line with that increase that's forecast to 2030. We're expecting further increases from different producers, so Qatar, for example, but not until sort of late 2026, so more of a driver for next winter, perhaps. This sort of increased reliance on LNG and phasing out of Russian gas supply does mean that any sort of impact on prices of the conflict or the war in Ukraine may be limited, but it does open up prices to be more susceptible to sort of global events. So things like conflict in the Middle East and any unexpected weather events can impact the export of LNG and therefore can be supportive of prices. So remains to be seen whether or not we'll see any of that this winter, but so far really strong underlying fundamental being that we've got really strong LNG supply. So the final thing I wanted to touch on today is the weather, which is obviously a really key driver as we go through the winter months. Any colder temperatures, obviously we would expect an increase in terms of heating demand can be supportive of prices, and whether or not we've got that sort of windy, stormy weather, obviously impacting the amount of renewable generation that we see. So I mentioned on the previous slide that weather can impact the export of LNG from the US. A lot of the export facilities in the US are on the Gulf of Mexico, which means that any sort of hurricanes in the Atlantic hurricane season can cause damage to infrastructure, cause issues with shipping, etc. But the 2025 hurricane season ended a few days ago on the 30th of November with minimal and no major disruption to LNG supply. So that's now passed for this year. But in terms of what to expect for the balance of winter when it comes to the UK weather, we're expecting temperatures in December to outturn above seasonal norms over the next couple of weeks. We've got a period of relatively significantly above seasonal normal temperatures forecast, and the likelihood of sort of wet and windy conditions is relatively close to normal. And that sort of continues then into Q1 2026, the forecast remaining relatively in line with climatology, so very close to seasonal normal across the board with a slight bias to warmer temperatures. If you're interested in a bit more detail around the sort of weather events and the teleconnections behind those conditional forecasts, then again, there's a bit more of a breakdown in our winter outlook paper. So it's a really high level overview and a whistle stop tour in terms of what we're expecting to drive energy markets over the next few months. You can see on the screen here some different drivers or an overview of all of the drivers that we take a look at as a desk. So I've sort of given you a brief overview of some of the power drivers and the gas drivers and weather. I haven't touched on geopolitics, but of course any sort of policy changes within the EU, any conflicts, whether that be the Middle East or the war in Ukraine, and any tariffs in terms of the trade war that's going on with the US at the moment can also have a really big impact in terms of supply or demand dynamics and therefore on prices. And of course, then there's always wildcards, expect the unexpected. There's always something that you can't predict that will come in and drive markets in one direction or another. So like I say, if you're interested in learning more, then please do go onto the Empower Business Solutions website and request a copy of the Winter Outlook paper. But that's all from me for now. So Caroline, I'll hand back to you to introduce the next speaker.
Brilliant. Thanks, Emma. I think it's really interesting to see how, despite Brexit, we continue to have mutually beneficial power sharing arrangements with Europe. And also a key point, I guess, is how battery storage is now finally starting to deliver some of the marginal benefits we envisage. So yeah, brilliant update. Thank you. Okay, so next we have Stephen Evans, our industry costing manager.
Hello, everyone. Thank you for coming along today. It's going to be fairly whistle-stop here as well, because we've got a lot that we'd like to cover, including some headlines that have been big and trending on the BBC News and other vendors today. So we'll look at why non-commodity costs are increasing and the government decisions behind that, particularly the RIIO-3 gas and electricity network decisions that were made by Ofgem this very morning. We'll look at how increases can impact your energy costs, concerns that organisations may have, and perhaps most importantly of all, practical things you can do to manage these increases. So it all begins, it seems these days, with Clean Power 2030. I think Empower Business Solutions as a company is very much committed to safe, secure, sustainable energy, so that we're not quite at the whim on our electricity, in particular, say, at geopolitical events that are affecting the gas market. So we're committed to it, but not at any cost. Prices have to be managed, and there's an excellent interview that Anthony Ainsworth, leader, did a couple of weeks ago on our YouTube channel, talking in more detail about that. But for now, a very, very quick recap. Clean Power 2030 is the government's commitment to generate 95% of electricity from clean sources. That's sources that don't emit CO2, so includes nuclear, as well as renewable wind and solar, by 2030. And as the graphs on the right show, that includes a tripling of offshore wind and a doubling of onshore wind. But one other element of Clean Power 2030 that I particularly want to focus on for today are the electricity networks and connections. There's no use in building lots of wind farms off the coast of Scotland, for example, if you haven't got wires big enough to take the electricity generated both to the mainland and then down to England and to the large customer base that need it. And the cost of those networks is as much, again, as the cost of the renewables. It's particularly high because of a systematic underinvestment over the last 30 or 40 years in the electricity networks. So clean power is driving pretty much everything that's happening in non-commodity costs at the moment. This, apologies for the terrifying graph that I bring out every time. The pinky purpley sort of color is the non-commodity costs, while the blue is wholesale. You'll notice that blue is very volatile, and that's the word that Emma has to deal with, while the non-commodity costs are going up in a more consistent way, but it's a one-way ratchet, certainly to date. And actually, I was talking about this with the CEO of the whole E.ON UK group, Chris Norbury, prior to going his attendance at a government select committee. And off the back of this graph, we came to the conclusion you could get to a position by 2030 where if wholesale price was zero, bills would still be the same as they are today because of the increase in non-commodity costs. Not that the purple into the future has to be at that level, but that's the sort of level that it's likely to be at unless something drastically changes. So I particularly want to talk about the pain that customers are likely to be experiencing, and particularly the focus here, of course, is on very large businesses, but it's an effect that domestic and small businesses will also feel of year-on-year increases in costs. So we're going to see a small increase in the nuclear subsidy. We're going to see bigger ones in the renewable obligation and feed-in tariff costs, particularly driven by inflation, although there is a proposal to change the indexation of our own fit from the slightly higher retail price index down to the slightly lower consumer price index. GEOS is the distribution use of system, which is again they're coming towards the end of their 5-year window, which ends in a couple of years' time, with a lot of costs that hadn't been or revenue that hadn't been realised earlier in the scheme being pushed back towards the end. And then TNUOS is an absolutely astonishing increase of about 75-80%, and that's what I want to look at in a bit more detail today, because myself and colleagues were up at 7 o'clock this morning trying to digest the final determinations. That's the name of the decisions that Ofgem make on the business plans for electricity transmission and gas transmission and distribution network operators every 5 years for the new RIIO regulatory time frame. And the headlines, the bad news, I suppose, as going back to the previous slide, is that in line with the draft determination and widespread expectations, transmission network costs are going to go up a lot. The very thin lining on that very dark cloud is that it's likely to be more like 75% rather than an 80% increase, because Ofgem decided on a 3% reduction in allowed revenue. In particular, that's likely to lead to a 5% cut in revenue and costs for the first year. On the gas side, I know most of you will be primarily interested in the electricity, but the gas distribution cost is held at the same level as the draft determination, while gas transmission level revenues are going to be increasing slightly as they've been refining some of the numbers around the very detailed business plans. So broadly speaking, overall electricity and gas network costs will be in line with previous expectations, which is not great news. It could have been higher, I suppose, but the announcements today are only covering the revenue that the network operators are allowed to collect. It doesn't actually set the precise capacity charges and unit rates and triad payments that are going to be charged. That's now got an 8-week or so process between now and the end of January, whereby we're going to see the more detail, having had the high-level strategic view, crunching an awful lot of numbers to turn that into some practical unit rates and capacity charges. So on the 15th of December, we'll get some draft TNUOS rates from NESO. We'll also get some draft revenues from the gas companies at the beginning of January. The big dates are the 31st of January, by which time NESO has to publish the final 26-27 TNUOS tariff, and we get the final gas distribution and transmission rates. So some bad news on the electricity networks. This slide is trying to put the electricity networks into a slightly bigger context of all of the different largely Clean Power 2030 related change that we're going to be seeing over the next few months. Just before we do, and off the back of the announcement, the RIIO announcement today, we'll go on to our second poll of the day. So the final determinations are a good step towards realising the clean energy transition. As a statement, do you strongly agree with that, slightly agree with that, neither agree or disagree, slightly disagree, or strongly disagree? And let's have a look at how the votes are coming in. It's a fairly even split at the moment. We've got about just over 70% are agreeing to some extent, 14% are disagreeing, and 13% or 12% are unsure. So generally seeing this as a positive thing, although not I doubt the CFOs of lots of these organizations will be seeing it in quite such a positive way. Back to the to this slide. This is showing each row, and don't worry, I won't go into very much detail, but each row shows a different initiative or change or proposal taking place for modifications to non-commodity costs. And what we see here is an awful lot of costs changes over the next few years to new wholesale DZ and possibly changes to consumer price indexes hitting from April of next year. There's then a whole swathe of purple hitting in April 2027, which includes things like the British Industrial Competitiveness Scheme that Caroline talked about earlier. And we're going to be and have been tracking these very, very closely, and we will hear a lot more about this over the coming months. Very quickly to close, then there are some things you can do with electricity costs going up a lot on the back of non-commodity. There's never been a better time to work on energy efficiency and reducing consumption, because every megawatt hour saved now, you're saving an awful lot more money than you were maybe 10 years ago. On-site generation is also really good, because every megawatt hour that you generate, and it doesn't have to be renewables, it could be diesel or gas or something else, is a megawatt hour that you're not paying renewable obligation or fit on. And if you're able to reduce your consumption and your generation, you may be able to reduce your network capacity, which in turn will reduce the standing charges associated with the network costs. You may also want to think a little more about the capacity market. It's actually the most expensive of the costs that you pay. Between 4 and 7 p.m. Monday to Friday, it's an extra 20 pence a kilowatt hour on top of your existing bill. So the bill effectively doubles between 4 and 7 p.m. Monday to Friday. So those are some practical things you can do. Clean Power 2030 is not only something that NBS is supportive of, but is affecting non-commodity costs in a whole load of ways. And we've had some announcements today that confirm network costs are going to be high, although the actual rates won't be confirmed until the end of January. Do think about flexibility and on-site generation. And just to tee Ben up, we have a new energy cost calculator, which can help you to better understand these costs.
Well, nicely teed up, Stephen. Thank you.
Thanks, Stephen. Sorry, apologies, I was on mute. The saying of the century, but yes, thanks for that, Stephen. It was a great update, and I'll hand over to Ben, our Director of Commercial and Data and Metering Services. Thanks, Ben.
Hello, everybody. Good afternoon. So a few headlines for me from our business energy tracker. So there we are, moving along. So the business energy tracker is something that we do every year, and it allows us really to represent the views of businesses through to policymakers in government. It really helps to have some data to inform those conversations, and this is one of the ways that we gather that on energy in particular. We then walk that around the policymakers, we walk it around some of the other bodies representing businesses in government. So let's find out what the 2025 npower Business Energy Tracker had to say. So we went out there, as I said, and got views from around 130 major energy users. We get a good spread of sectors. This year in particular, we were asking about, these changes in non-commodity costs. How are people feeling about that? And this is the 4th year in a row that businesses came back saying energy is a worry for us. Energy is the top risk that we're facing into as a business, and we really need some help both from suppliers and from government. So that was kind of the findings here. And this is always interesting for me every year. Every year I'm expecting, does the shadow of the Ukraine war start to come out of this, and businesses are starting to worry about other things? But no, energy came out for the top risk businesses are facing for the 4th year in a row. So the other thing to say is, while we're worried about this, businesses are still, by a strong margin, believers in the clean energy transition. They're seeing the other consequences of climate change that could come through to influence their profitability, their balance sheets in the coming few years. So there's a belief set still in clean power as a thing that we should do, and we mirror that internally as well. We think this is something we should do, but there's plenty to disagree and argue about and influence on the detail of how that comes through into delivery and into bills. So businesses are still seeing that they've got a responsibility to do this, still seeing that there are the benefits in there in terms of, eventually some cheaper energy, particularly if some of those steps are taken that Stephen talked about in terms of on-site generation and energy efficiency, seeing the benefits of greater security of supply, less carbon emissions, and boosting their social responsibility and the ability to invest into businesses in this country. Additionally, we asked the question, do you think you should be paying for this? And 57% of businesses recognise that they're going to have to contribute towards the costs of these measures. So there are serious concerns. Yeah, this is the strongest reading I've seen from any survey ever. Yeah, 97% of businesses are concerned about the rising costs that are being driven here to support that low carbon transition. Almost half of businesses are expecting a large increase to their non-commodity charges. You could take that two ways, right? Either businesses are listening here and they've heard it, or half haven't twigged this yet, and they're already setting budgets and expected costings and pricings for future years that don't take into account some of the changes that we know are coming in terms of non-commodity charges. And that's something that we're doing the best that we can within MBS to get this message out there. Regardless of the rights or wrongs of how this is being done, businesses need to be aware of the per unit costs that they're going to see for electricity over the coming few years, so they can bake that into their business models. So yes, here we are, and businesses clearly again recognizing that a significant portion of the energy bill is coming from those non-commodity charges. So that's really positive in a way that businesses are getting an understanding of this stuff. But there's not too much in terms of real ability to crack these costs yet. So I would like to ask you, our webinar audience, to help me out with a poll. So who should fund the infrastructure for clean power? We know this stuff needs to be done. We know businesses back it, but who should be funding the infrastructure here? Just going to let the votes tick away for a minute till we get up to a decent sample here. We've got over 100 people on the webinar, so I'm really grateful to you all for joining us today. Hopefully this is proving useful for everyone. So we've got two clear winners here. Unfortunately, neither of them are the ones that the government is currently pursuing. So we've got a two-horse race emerging between government funding and general taxation on all consumers. I think we'd recognise that in the long run, those are both the same thing, aren't they? The attendees on our webinar are looking for more government balance sheet action in terms of delivering that. How can we relate this to the business energy tracker findings? So we could take perhaps 30% here as recognizing that this is going to come through on bills. So who should pay? Looks like we're slightly over-indexed on government funding in terms of, oh no, here we are. We're probably about flat, aren't we? About 60% there, about 60% there in terms of a mix of government funding and general taxation, but also the recognition of some levies and charges on other energy users. Good. Well, thank you all for your participation in that one. Internally, we are pushing through the channels that we have at the moment to say, look, is it right? Is it right that we're seeking to pay for all of these changes to the energy system over the next few years, or should we be looking for a longer term funding mechanism? That's a conversation that we're having with government policymakers at the moment. I don't know if that will come to fruition, but it seems sensible to me that we would take the opportunity to spread these costs over a longer time horizon. So within the tracker, we also asked, is more government support needed? And around half are probably where I am, to be honest, that around half, something's being done, but it doesn't feel equal to the scale of the challenge that we face. And I think that's about right at the moment. So definitely something's being done. We've seen that in terms of some of the things I'll talk about in a moment around the business British Industrial Competitiveness Scheme. Sorry, get my teeth back in, and the NCCS, the Non-Commodity Costs Compensation Scheme, which went live a few months ago. But there's not much being done for the vast majority of businesses in the UK, and there's a fair gap between what we really need to close that gap between power prices in the UK and power prices at least on the continent of Europe. So let's talk about the fact that the government is picking winners now. So for best part of a decade, we did not have a formalised industrial strategy. We do now, and the government have identified they're called the IS8, the industries which the government wishes to support with lower electricity bill costs. And the government are consulting on some of this at the moment, and obviously we are responding to those consultations. Probably two angles in terms of the response from my perspective. The first is this thing has to be operable. So it can't be so complicated that businesses can't access it. It can't be so complicated that loads of people miss out because they're not aware that they're eligible for this support. And the second bit is really around, if you squeeze the balloon in one part of the energy industry and you're just redistributing it to everyone else, is that really what we want to do? But that's some of the logic of having to pick winners here. So what have businesses asked for? Top asks for government. Development of the CPPA market. I think that those of you who've tried to conduct CPPA agreements, they're quite legal heavy. It's quite difficult to get those over the line at times, particularly when you have to line up a lot of internal stakeholders in both organisations, potentially 3 organisations. Businesses looking for some more direct financial support, particularly for either running their business or particularly for on-site energy generation, and in general a bit more support from government, a bit more fire, please, in the support model. As I say, policymakers are listening to us on this stuff. So we had a lovely letter back from Michael Shanks last year, and we are actively in discussions with policymakers at the moment about helping to shape this agenda for the next few years. And if you'd like to get an idea of the impact on your own business for your own meter or meters, but you can only do one on the form, have a go at our energy cost calculator. It's the first time we've done this, but you can stick in the details of one of your sites and get an indication of how those costs are going to change over the coming few years. So yeah, look, if I summarize this up, Clean Power 2030, we fully back it. We think it needs doing, but there is going to be a price to pay, and across sectors that is going to be a little bit different, particularly given that the government are picking winners and losers through the industrial strategy at the moment. Thank you. Back to you, Caroline.
Brilliant. I'll come off mute now. This time. Thanks, Ben. Really interesting, and I think it's as we appreciate Clean Power 2030 is a must. It was interesting that there wasn't a single mention of it in the most recent autumn budget. But yeah, great insight. Thanks, Ben. Okay, so finally, our last presenter of the day. So Matt, I'll hand over to you.
Hey, Caroline. Hello, everyone. My name is Matt Cullen. I'm a senior strategy policy manager here at Empower Business Solutions. And today I'm hoping to talk to you about a topic that's been kicking around for a couple of years. And this summer, the government finally decided to make a decision about REMA, which is the review of electricity market arrangements. It was a large policy decision to be made about various parts of the electricity market and how it was going to move forward. And there were some really radical ideas in there that really took a lot of the headlines. And I'll go through some of those in shortly. But if I just say so I'll recap what DESNZ said in their summer update, and where on what they're planning to do off the back of that, and the timeline for that. And then just quickly, just to point you in the direction of what that could mean for any investments that you might be looking to make for your business in terms of flexibility. And then finally, just to let you know what we here at npower Business Solutions are lobbying on. So as I said, the REMA projects have been running 2 to 3 years. It was looking at really shaking up the wholesale market, how we buy and sell electricity as a supplier. One of the big things that kept catching the national headlines was maybe a move away from national pricing and a move towards more of zonal pricing. So you could have different wholesale prices at different parts across the country. The idea of that being that it helped alleviate some of the constraints that Stephen was talking about earlier on, where you get a lot of electricity generated in Scotland, but the network isn't powerful enough to get it all down south. That the system operator has to do is he has to turn off wind turbines in the north, turn on expensive power stations in the south in order to meet the demands, because the network is insufficient. And then that additional cost gets charged through to customers through BSUOS. So like I said, it took 2 years, but government finally decided that they would not go ahead with zonal pricing on the basis that they thought it would really damage the investment needed to deliver Clean Power 2030. And there were huge distributional challenges about how you made sure that everybody was fairly, how it was delivered fairly, and that there wasn't a postcode lottery. But they did go further on from that. They did talk about other options that they do want to pursue. One of those was the reformed national pricing model, which was in the title of this subsection. We're expecting more detail about that early in the new year. So maybe at a future webinar, I can come back and let you know exactly what they're thinking is on that. But what we do know is that it will contain is maybe more of a move towards central planning. So the government at the moment are delivering or trying to pull together a strategic spatial energy plan, or the SSEP, and that will use non-commercial levers to try and encourage people to build new demand and new generation in parts of the network that are better suited to it. So it will make it harder to build generation up in Scotland, and it subsequently could also make it harder to build demand down in the south. So the levers that they will typically use will be things like connections, seabed leases for offshore wind, and planning and in those sorts of areas. So we're expecting the SSEP to very much drive the focus of where power stations and demand will be sited in the future. But also they're also talking about massive changes to TNUoS. I think what Stephen said earlier on about TNUoS having to leap up by 75% next year. It just goes to show how broken TNUoS is at the moment, and so they're looking to review TNUoS. I said I had strategy in my title. That's because this TNUoS reform will not come in until 2029 at the earliest. So unfortunately, it's not something that we can tell you is going to help drive down your bills tomorrow, but in the early 2030s, it should do that. And finally, they're also looking to review the balancing mechanism, which is the market where all the short-term purchases of power are made to just balance off those very short-term fluctuations. They're looking to make the balancing mechanism bigger by encouraging more people to join it, and also trying to create new sub-markets off the back of that deal with constraints. which demand and generation alike can equally take part in. So if you have assets that you can flex, or you have some on-site generation, that is something that we can help you with, looking at whether there is a source of revenue for your business there. As I said, I'd talk about the timeline quickly. So we're in the last quarter of 2025 now. We were expecting to be told more details about the SSEP this quarter. I think it's probably going to fall into the new year now. We're also expecting a full CBA on the decision about zonal pricing, but that ship really has sailed now, and I don't expect it to really be brought back again, despite some very loud voices calling for it earlier in the year. But we will get more detail about all of these reforms that I've just talked about, and better timelines for when they might come about. We're also expecting some details on reforms that kind of got put on the side, on the shelf, whilst the decision about zonal pricing was being made. So looking at the capacity mechanism and the CFD mechanism as well, and how that can be reformed. But we do know that the SSCP, in its first iteration, government will have to make a decision about that in Q2 next year, and then put that out to consultation. So we can, by Q2 next year, we'll be able to tell you what the government is expecting new builds in generation and demand to be like, and where they're expecting it in the country, and what impact that might have on things like TNUoS and prices. I've kind of shown this going right out to 2029, just to give you that idea that a lot of the reforms that the RMP, or the Reformed National Pricing Mechanism, is looking at aren't really expected to kick in much before 2029, 2030. And on the back of that, I've got a poll that I think is going to come up. Yeah, and we're just asking you about what you hope the biggest benefit will be from all of these reviews and reforms coming through. So better cost reflectivity of prices, maybe you expect price volatility to come down, or just a more efficient energy system. Maybe what you think is most important to be driven out of these reforms is energy security. And the final one just being a more transparent system. So, I've got to submit my own vote, haven't I? I keep forgetting that. Right, so let's have a look at what those polls are saying. So we've got we've got fairly even spreads, but at the moment we've got 30% saying a fairer, more transparent system overall, and we've got 23% saying better cost reflectivity in prices. I think it's fair to say that nobody knows for sure exactly what these reforms will deliver, but I think all of those are very sensible options, and certainly will help us deliver better prices for you. I said I'd quickly talk about what it might mean for flexibility investments. So that the SEP is unlikely to have much of an impact on you unless you are a transmission connected customer, because the SEP is going to be a very high level plan designed at transmission level. Obviously, if you are on the EHV network, that you might have quite big impacts from local changes to the transmission network. But if you're on the smaller side and you have behind the meter flexibility, we don't expect much change to come about from that. For TNUoS reform, we do expect, if you are looking at on-site generation, and especially, again, transmission connected on-site generation, that the connection charges will increase. For a long time now, we've run on what's called connect and manage, where you are given a connection regardless of what that'll do to the system. That's now going to be stopped, and we're expecting connection charges to kind of ramp up if you are trying to connect to a very constrained part of the country, and vice versa if you are trying to connect to a less constrained part. BM reform, We do expect that to make the BM far more competitive, but there are some things in the BM reform that they're talking about, such as when gate closure and trading deadlines occur, that would be detrimental for batteries. So if you're thinking about that as an investment for your business, please come and talk to us, and we'll let you know what we know about what's in the BM reforms and what it might mean for your investment. And finally, one of the big things I didn't mention is that the government are also looking to move from half-hour settlement periods to shorter settlement periods. So it could be as short as 5 minutes. And that obviously could have a massive impact on you as a business. If you are having to send us forecasts of what your demand is going to be every 30 minutes, it will suddenly have to go down to 5 minutes. But there again, that's not anytime soon. We could expect that to take at least 5 years to come into fruition. So we are lobbying on all of these fronts, and especially trying to help government understand what all of these might mean for customers. There has been a bit of a generator fixation within REMA, and we're keen for the Reform National Pricing Model to kind of bring back the customer lens. So we are pushing on that strongly. We're also pushing on areas that I just talked about briefly there, especially around the CFD and the CM, which will, if they in their current guises, could have quite dramatic impacts on liquidity and volatility of prices. And we really want to kind of spot that iceberg off in the distance and steer around it now, rather than waiting until we're kind of right up close to it. And I think that's the end of me.
Brilliant. Thanks for that, Matt. What I took away from your presentation, along with many things, is just how many components there are to reform, and trying to kind of get those to align and work together is such an incredible task alone. But great to see that we're advocating when it comes to customer impacts and their requirements. So yeah, thank you for that. Okay, fab. So we've got about 7 minutes left, so not too long to get through the many questions that we've had. So we'll just kick off with the Q&A session. Everyone should pop up on the big screen. There we go. Real. Okay, so let's have a look.
So we've had a couple of questions, Caroline, around the practicalities of, are people going to get the slides and a video of this stuff? Yes, it'll all be available afterwards and sent out for everyone. So absolutely, if you want to share any of this content with colleagues, you'll be able to do that after the session.
Yeah, we will. And any questions that we don't get through today as well will also be answered by email. So yeah, we'll share everything that we've ran through and that we go through. So that's fine. Fab. I guess staying on you, Matt, I know we kind of touched on this in the presentation a little bit, but so have Clean Power 2030 ambitions sidelined REMA, or is there still a push to progress reform?
No, there is still a push for reform. I think everybody recognises that Clean Power 2030 is a great aspiration, but it's not just about banging up as many wind farms as you can, because everything, as you said, has knock-on impacts. And so, as Steve will tell you, they spend an awful long time trying to work out what wind farms going up would mean for TNUoS charges. Emma and her team will spend hours trying to hedge when the more wind turbines come on, more and more of that volume gets pushed into the day-ahead market and makes it harder for us to hedge. So all of these clean power aspirations are brilliant. We just have to be aware that our markets and our mechanisms are maybe not fit for purpose for 2030, and they do need reform. And so REMA was the start of that. The Reform National Pricing will also hopefully deliver that as well. I hope that answers the question.
Brilliant. Thanks, Matt. And Ben, I guess it kind of follows on nicely to Matt's question. So clean power is clearly a concern, or a positive that comes with some concerns. What else do you think business should be concerned about or have in mind for next year?
So I suppose the things to have in mind, if we start on a positive note,
Yeah.
you know, the business case for on-site generation has never been better, and the business case for energy efficiency and thinking about when you consume power has never been better. So there's fantastic opportunities for people to, you know, invest into their business's capabilities locally and see that monetized through lower energy bills. So I'd encourage businesses to think about that. Other things to have on the horizon, I think it's probably some of the usual stuff around, you know, we continue to see changes to taxation, particularly employee taxes. So that's something to keep an eye on, as well as the potential changes to the fuel duty escalator. I think that's well worth keeping an eye on as well.
Fab. Thanks, Ben. We've probably got time for a couple more.
So we've got one around the BIC scheme, the British Industrial Competitiveness Scheme. Yes, that runs alongside the existing energy intensive industries scheme. So that there's now a proliferation of schemes, but the EII scheme is only aimed at around 500 businesses. The BICS scheme is aimed at around 7,000 businesses. It's definitely something to keep an eye on for those running businesses out there in the world. Which of these schemes and any future schemes are you eligible for? Make sure you're not missing out on money that you could be claiming from those schemes. Equally, be ready to grab any potential grant funding that the government might announce at short notice. Some of that stuff seems to be coming out with very little in the way of pre-warning for people, and it's quite often first come, first served. So be ready to take advantage of those opportunities and keep a weather eye on the horizon for schemes that could benefit your business.
Completely agree, and we expect the size of the BIC scheme to probably be comparable in size in terms of the terawatt hours to the EII scheme. I also noticed we've got a question about TNUoS increases. Do I think that DESNZ will match it in 2028? Obviously, it's not a competition, and there are very different motivations for investing in transmission network, which is, as I said, is because all of the generation that you want is in the wrong part of the country, whereas you invest in distribution because you've got a growth and a proliferation of small scale generation and batteries, growth of EV charging, which means you might need stronger reinforcement to areas of the distribution network, and dare I say AI and data centers also may mean that there's a flurry of people wanting now to connect to the distribution network. So I hope it certainly won't be of the scale of TNUoS. And 2 years, I've learned, is an awfully long time in energy, certainly at the moment. But I'm afraid I'm expecting some sort of sizable increase, but hopefully nowhere near the scale of TNUoS.
Brilliant. Thanks, Stephen. Thanks, Ben, for picking those up. We're about done with time, unfortunately, and there's still quite a few questions to answer. So like I say, we will follow up on email. Emma, you've had some come in around the markets as well, so I'll make sure those come over. And again, as Ben said, we'll share a recording of today's webinar in case you want to watch any sections or share it internally with colleagues. Just one final plug. So we do share quite a lot of energy insights and energy news on our LinkedIn page, npower Business Solutions, so please feel free to give it a follow. You may find some useful information on there. Okay, so that's it. Thank you to our presenters today. Hopefully you've taken something away from today's webinar, and thank you so much for our audience and your participation in the polls. We hope you found it useful, and hopefully we'll see you again in 2026 now with our next Energy Insights webinar.